Stanley did raise its price target to $450 a share, which is up from $350 and obviously implies about $10 of upside from where we're currently trading. They did also keep their equal weight rating. And while the firm did raise estimates to reflect higher expectations and competitor withdrawal, it does now see more balanced risk and reward from here. The firm argues there may be more risk of multiple compression from here than multiple expansion on a 12-month view, given that much is expected from paid sharing as well as the overall ad tier. And of course, this is a name that has gotten so much analyst coverage in the last several months just based on the fact that they have been undergoing a major restructuring in terms of how we as consumers do obtain our Netflix and in terms of their advertising tier. A lot has changed in the last couple of months. So it's interesting to see of the 35 analysts covering this name, the holds and the buys are relatively split right now. So definitely still leaning more bullish, but I would say there is still a fair amount of neutral speculation in regards to Netflix, which is up about 48% now year to date. And I'm curious, Caroline, because we were both saying we were kicked off of our Netflixes. We were part of the paid sharing that we lost our access. I'm curious if you've signed up, because I have not. I don't know why. I'm not necessarily holding out, but I have not re-signed up for my Netflix. Now I'm trying to see how long I can make it.
Yeah, I haven't either, Jenny. Not quite ready for another monthly fee. So I have read a lot more books than I previously was reading. So no Netflix for me either. I'm holding out with you. Meanwhile, we're also taking a look at some EV makers this morning. Barclays raising its price targets on some EV makers that are not Tesla. Rivian, Ford, GM. Rivian continuing to charge higher. It's up about 50% so far in July, and it's only the 10th day. Meanwhile, Ford and GM not really getting much of a boost, but fill us in on these calls.
I know Rivian, if I hadn't talked about Rivian on Friday, I wouldn't have believed that it gained 48% last week alone. I mean, it was a wild week for Rivian shares, as you can see there. Now it's up over 35% year to date. So this is a rally that actually is making a sizable difference, even on a 12-month basis, as you can see there, despite the fact that we are down about 1% today off the open. Now, regarding this Barclays note, they do expect a second quarter beat from Rivian and for this momentum to continue. They said the company serves as an EV alternative to Tesla, and they also expect a second quarter beat on stronger than expected deliveries and fixed cost absorption benefits to their gross margin result, alongside continued operational self-help. While the rally in shares has emerged over the past month, they actually think there is even further upside to the stock as investors are increasingly comfortable with Rivian's path to break even. They did also raise their price target to $30 a share from $22 with an overweight rating. Now, when looking at Ford and GM, more stable names this year, yes, but definitely still relatively smaller in terms of their EV footprint. We actually got some of Ford's delivery numbers last week, and 2.8% of their overall revenue is derived from EVs. So I always think that's important to note that the scale in which the Ford is such a large company, but their EV footprint still relatively small overall when looking at their total revenue. Now, we did see Barclays raise its price target on Ford to $14 from $13 with an equal weight rating, and they did also raise then their price target on GM to $46 from $42, also with an equal weight rating. So just modest raises there, but they said stability is emerging for the auto sector, but beware of the high bar into earnings. The firm sees some risk in this environment, and the bar has clearly risen for autos into this next upcoming earnings event and has been reflected in a lot of these auto stocks. So as a result, Barclays does urge investors to set their expectations accordingly now into earnings. So different momentum here as they do look to Rivian and see outperformance. They see right now more Ford, GM being priced to perfection, just given the overall expectations in these names. Now, Ford is up about 30% year to date. GM is up about 18% year to date. So again, not necessarily sizable moves, not a lot to be excited about, but definitely at least GM gained 3% last week. We are seeing a recent uptick in, I'd say, investor focus on these names overall, Caroline.
Although some sluggishness today, and even Rivian actually gave up those early gains and is now negative off about, it's basically flat. It just keeps bouncing back and forth across the unchanged line. Jenny Horn, thanks so much. Now let's take a look at some more movers. For that, let's bring in Jeff Pierce, Senior Manager Derivatives Trading at TD Ameritrade. Jeff, thanks so much for joining us.
Thanks for having me.
So first up, you're looking at Meta, which is a winner today, up about 2.5%, and Threads continues to grow. I did join over the weekend, although I haven't actually been active. What about you?
Yeah, I'm on. I've posted once. So far, I like the usability. I think there's certainly a lot to be done on the application, but we're seeing more and more users join every day. Meta's Threads actually surpassed 100 million signups since their launch on Wednesday last week. If we look at some of this timeline, day one, they hit 2 million signups in 2 hours, 5 million in 4 hours, 10 million after 7 hours. By the next day, they were up to 30 million. It's likely that the simple sign-up process has a lot to do with the success that we're seeing, and the fact that Threads is available, across Apple and Google Android across 100 countries. But if we look at some of these comparisons and these milestones, I mean, TikTok, it took 9 months for them to get there. Instagram, it took more than 2 years. ChatGPT reached 100 million by about 2 months, and that at the time was the fastest growing. I mean, people really didn't expect another app to grow that quickly. If we compare to Twitter, which is a little bit difficult to do, but in November, Musk said that Twitter had about 260 million active users with a plan for them to get to 1 billion by 12 to 18 months. Threads numbers aren't directly comparable because we're not looking at active users in the way we would with Twitter. But nonetheless, it's a pretty impressive jump so far we've seen out of the app.
Yeah, 100 million signups, very impressive. I think the big question is how much advertising revenue can all of these social media companies actually bring in? But it seems like the fight between Musk and Zuckerberg is only heating up. There's the cage match, but it seems like this could also get legal because Elon Musk is threatening to sue, right? Because he's saying he's basically just stealing his ideas.
Yeah, that's absolutely right. And certainly we've seen from Meta before them taking ideas from other companies and, basically creating their own applications from that. Similar things we've seen when they were trying to compete with TikTok. You think about the Reels that we've seen them add to Instagram. There's also, of course, to your point, it's not just about them adding new users. It's about users actually utilizing the application. And there's a lot to be done for Threads. They have no post search, no direct messages, hashtags, no following feeds yet. There's also some privacy issues over in the EU that have so far blocked the app from launching. So there's some question marks out there for Threads in the long-term game, especially if we look at them compared to Twitter.
All right. Well, it doesn't seem to be weighing on Meta shares today, any of those potential headwinds. They're up about 2.5% to kick off the week, up about 147% year to date. Other stocks that have been doing quite well recently, travel stocks, they've been in rally mode. And really, I'm taking a look, airlines, cruise lines, Expedia booking all higher today despite the market's overall sluggishness. And United Airlines is up about 0.5% today and just got a price target hike from Citi. Fill us in on that.
Yeah, absolutely. Consumers concerned out there, but not concerned about stopping their traveling. We've seen that, as you pointed out. Citi raised the firm's price target on United to 75 from 70, kept a buy rating on the shares. The analyst says confidence on the new normal is improving, which is driving a more upbeat sector assessment, prompting the firm to increase their target multiple for United. Obviously, this is a stock that's already up 57% over the last 12 months. We've seen high demand, stable gas prices. Those have all helped boost the airlines this year. Summer revenues appear to be strong as well. If we look at the last earnings report, especially on the guidance side, very positive. As the company said, near demand was strong. Q2, they're expecting earnings per share of $3.50 to $4, revenue to rise 14 to 16%. They also think capacity to be up about 18.5% from last year. Cost per seat mile could be flat to up 2%. And, one of the more interesting parts is that international demand, they said, is growing twice as fast as domestic demand. We know that these airlines have had some issues, and there's some expectation of, when we go into Q2 around seeing how the July 4th weekend did. United and other airlines have had some problems with having to cancel flights. United has made some adjustments. We saw that last week. And now it's just a wait and see moment here for investors to see how they've been able to handle some of these issues.
Yeah, so Delta obviously reporting on Thursday. Delta shares also up this morning and also seeing about a 50% year-to-date gain. So based on this analyst commentary in terms of airlines and this new normal in spending, it sounds like we should potentially hear some pretty upbeat commentary from Delta too.
Yeah, I think the expectation is that with gas prices the way that they've been, fuel prices the way that they've been, with their ability to continue to drive demand and the fact that strength has not seemed to come down, for the consumer out there, that bodes well for a lot of these airlines. Expectations are very high. The big question mark, of course, is the cost. How have they been able to do that? Deal with that? Certainly, some of the flight delays and cancellations. What sort of impact we're going to see that have on their revenue and their margins as well. But overall, I think there's a lot of optimistic tone coming from analyst investors that these airlines have, a good runway, especially going through the summer months.
All right, so consumers not cutting back on air travel, but we'll have to see later this week if they're cutting back on Diet Pepsi or any Pepsi products, because Pepsi's also out with earnings later this week. Barclays out with a note ahead of those results. What is this analyst saying?
Yeah, they lowered the firm's price target to $198 from $206. They did keep an overweight rating on the shares. The analyst is above the street for Q2 estimates, driven both by organic sales and operating margin, although the firm says they have a more conservative outlook embedded for the second half of 2023. As you pointed out, we have earnings expected Thursday. Volumes have been lower, but luckily the company has had pricing power. That's really helped. The company's also worked to cut costs quite a bit. Margins have continued to contract. However, cash flow for the year, though, is still projected to be high enough to fund about $8 billion in direct shareholder returns, mostly through those dividend payments. That's something investors have been applauding. If we look at the last earnings report, revenue did beat up 10% year over year. Earnings per share beat as well by about 11 cents at $1.50. But what we saw were volumes were down. They were down 2% across all categories. Luckily, prices were up 16%. Food segment fell 3% on the volume side, but beverage rose about 1%. If you look at organic revenue, Lay's, Doritos, those other brands, those really pushed Frito-Lay North America revenue up 16%. We also saw beverage up about 12% on our organic revenue.
So I think the big question is, can these companies continue to pass all of those higher prices that they've been seeing on to the consumer? And it seems like we've been getting some mixed signals on that. I think it was General Mills that basically said they're no longer able to. How important do you think that will be for Pepsi?
I think it's extremely important. I think we're reaching that time where consumers are deciding to trade down in some areas when they're at the grocery store, when they're buying these products. In some cases, they're deciding to just fully, go without purchasing them. So it's certainly something that it could be company by company. Brand loyalty does play a role here. Expectations in terms of, the full year, they are expecting organic revenue to increase 8%. That's up from 6%. And earnings per share, they're expecting to increase about 9%. So there are higher expectations for the full year than what they had previously had. Nonetheless, I think that is certainly a concern as investors kind of eye these companies, whether or not the consumer is going to continue to be willing to pay these high prices. And with inflation, really kind of staying as it has, that is a question that the consumer is going to have to answer.
I don't know, Jeff. I prefer Diet Coke if I'm going to drink soda versus Diet Pepsi, but I certainly wouldn't be trading down to Diet fake Pepsi or Coke.
Yeah, it's a big step.
I'll pay the extra, I guess. All right, you're also taking a look at 3M this morning. Shares basically flat, or maybe a little bit higher, despite a couple of price target cuts today. Fill us in on those.
Yeah, this has been a tough few months for 3M. They're down 25% over the last 12 months, down about 21% year to date. Citi lowered the firm's price target on 3M to 100 from 120, and they kept a neutral rating on the shares. They said they're still durable. Durable demand trends for U.S. industrial should remain supportive of relatively solid results versus expectations, but most companies will likely remain cautiously optimistic relative to the second half of the year expectations, given some mixed economic trends and more difficult year-ago growth comparisons. I think certainly the comparisons are tough. If we look at the last earnings report, revenue did beat $7.78 million, down 9% year over year. However, earnings per share also beat $1.97 versus $1.58, but down 25% year over year. If we look at the adjusted operating income, that margin declined 22% from a year ago. Where it was, declined to 22% from 17.9% when we saw a year ago. And that's largely this inflation putting pressure on this company. Full year outlook, they're expecting sales to drop between 2% and 6%. They expect organic sales to be down as much as 3%. And we know that the company has been dealing with cost in part by laying off employees. We saw them eliminate about 6,000 positions during their last report.
All right. right, have to leave it there. Jeff Pierce,
Shortly
thanks for
expecting the
breaking
results
down
from the
all
Bank of
those
England's
movers for
gilt
us. Really
operation.
appreciate it.
Thank you.
I'm gonna go find you on Threads. Coming up next, it's Inside Out. We'll talk on Semi and Caesar.
Meta's latest product to rival Twitter, Threads, is exploding in growth and sign-ups since its launch. It's surpassed 100 million users within 5 days. That's according to some fresh data we've received this morning. Our next guest says, quote, Meta desperately needs this to work, but from a market receptivity perspective, the timing is fantastic. Joining us now, Roger McNamee, early Facebook and Google investor, Elevation Partners co-founder, and of course, frequent critic of Meta. Roger, what's your take on Threads and what it means to the company?
Well, David, I think it's really a perfect situation at a perfect time for Meta, but that doesn't mean it's easy work. So the company failed in crypto, and then it failed catastrophically with the metaverse. And given how mature the Facebook product is, the fact that it really doesn't have any growth opportunity left in its most profitable markets, and that Instagram is still under a lot of pressure from TikTok, Threads is an opportunity to go up against a competitor that frankly is, basically shooting itself in the mouth every single day. And as you've seen, Meta has 2 billion active users of Instagram. So signing up 100 million of them into this was obviously an effortless thing for them. Now the question is, can they in fact create the kind of community on this that Twitter had that becomes economically valuable? And I think the odds of that are not bad, but I don't think it's a gimme. And it's also not obvious to me that it's going to be that big, but we'll see.
Yeah, I mean, Twitter, listen, still a useful product, perhaps less so than it had been for many of us, though, who rely on news and information or use it that way to distribute it. It's not as clear to me that Threads is after that audience, Roger. Is that your take?
Well, the thing that Threads has is one of the 3 core constituencies of Twitter.
Fed's boss says inflation is far too high.
Every celebrity is on Instagram, and they all have just an enormous following there. So I do think that piece of the Twitter ecosystem moves very easily. The part that journalists and politicians, the 2 other big constituencies, look for, which is the real-time news environment, is going to be much harder for Threads to replicate. And I think, candidly, David, that what happened at Twitter was
Fed's boss says we are quite attentive to bringing inflation down to target.
It was never a great product. It was never monetized well. And candidly, they had an awful lot of problems.
Fed's boss says we have made a lot of progress on inflation.
So to me, all of that produced 500 million users in a business that's really never been profitable. And so for Meta to do better than that, I think is entirely realistic, because I think the people there are smarter than the people who've been running Twitter over the years. But
this stream is sponsored by To The Tick. Get free daily pivot points, Fibonacci, and market profile levels by signing up at tothetick.com.
So much bigger than Twitter's ever.
Oh, yeah, far bigger. But, you bring up an interesting point, which is Twitter never seemed to realize its opportunity because it never seemed
Fed's
to
boss
work
says
as
the
well
recent
as it
moves
could
on
have
rates are part of a
imagined.
process
For
to move
those
in a
who believe that
careful
when
way.
Musk took control, he would figure it out.
And Fed's boss says we are close, but we still have a bit of work to do.
I mean, Twitter, he's just made a hash of it. And I look at this and I think to myself, how hard would it have been to not make a mess of it? Well, maybe just pausing and thinking and trying before you just willy-nilly tore the place apart would have been a good start. I do think that's the place where Meta has a gigantic advantage. I do think Meta understands monetization 1,000 times better than Twitter ever did. The problem with it is that in a newsfeed model that works the way that Twitter works, you can't just jam it full of ads and have people still find value in it. And so I do think that Facebook's strategy and Instagram's strategy, which has been to load more and more ads into the feed will probably be okay in the celebrity world, but less attractive in the news and politics world.
Why do you say it's been a failure? I mean, it's hard to get any real metrics. Or, according to Musk, the engagement's never been higher on Twitter.
Yeah. And what do you think the losses are right now? I mean, the issues relative to advertisers leaving Twitter strike me as
But he's hired Linda Yaccarino, and that's her business. She's got a pretty big command over the marketing world.
I wish her lots of luck. I just think, you're on Twitter every single day. You watch what's going on there. And what Musk has done is to take away the equilibrium that existed, that it gave disadvantaged parties the ability to participate in the political process. He's made the thing much more partisan than it used to be. And as a consequence, by undermining a portion of the broad ecosystem, he changed.
Fed bar says rates are close to restrictive, but the Fed still has work to do.
It makes the product a lot less valuable to its users, at least to the ones who make the site really effective. And I still use Twitter, but I use it differently than I did before, and I use it less than I did before. And I suspect I'm not alone in that respect.
Roger, finally, I mean, Musk has, to your point, even in the last 24 hours, I mean, the stuff going back and forth, particularly from Musk and Zuckerberg, and this whole idea that they're going to meet each other in a cage fight. What's your take on that? Do you think it would be a good thing, a bad thing? Do you wonder, does it make you question certain things if these two actually do go at each other in a ring somewhere?
So, David, I look at this and I go, the whole thing is a distraction, right? I mean, one of the big problems that we've got right now is that we have the internet platforms like Meta, like Google, unwinding all of the disinformation protections they put in after 2020. You have a judge saying that the government's no longer allowed to talk to internet platforms to try to protect democracy against disinformation. And you put all these things together, and what is the thing we're focused on? A cage match. And I'm going, hang on just a sec. We have a 5-alarm fire going on in our democracy, and these guys are at the heart of it. And the question is, are we going to...
At 11 a.m. Eastern Time, we get New York Fed inflation expectations. We also expect comments from Fed's Daily, who's discussing inflation and bank supervision. No text, but a Q&A is expected. Fed's Mester, who speaks on the economic and policy outlook in a virtual event. Text and Q&A are expected. And Bank of England's Governor Bailey, who's delivering a speech at the Financial and Professional Services Dinner. The Bank of England will release a text at 4 p.m. Eastern Time.
That's where we are. Roger, always appreciate you telling us where we are, at least as you see it. Thank you.
Take care, my friend.
You too.
Coming up at 11 a.m., Guggenheim Partners Executive Chair Alan Schwartz, as he calls for one last rate hike in July. We're going to discuss that call and what he's seeing in the business in just 10 minutes. Stay with us. We're back in just a moment. Dow's lost a little bit of steam, up 142. S&P holds the gains. We'll be right back.
Fabletics.com.
We mentioned some of the weakness in mega cap tech this morning. Let's bring back Mike Santoli, who's been watching the NASDAQ and some of the mega cap names this morning. Mike?
Yeah, Carl, and some mechanical drivers perhaps to this action today. If you look at the NASDAQ 100 ETF, the QQQ, relative to the equal-weighted version of it, you see the regular one, the market cap weighted QQQ, vastly underperforming on an intraday basis. It's the very largest stocks in the index that are down today, and it's likely because late on Friday night, NASDAQ announced that they're going to do what they call a special rebalancing of the NASDAQ 100. This happens when the top of the index gets a little bit too concentrated. So you have the largest stocks, those that are worth at least 4.5% of the index each. So that's the Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, et cetera. When they get above 4.5%, if you add all those up, if all those big weighted stocks are more than 48% of the index, they do a special rebalancing, which basically just means they knock down the weight of the very largest ones. They're going to distribute that market weight across the rest of the index. And it's going to happen July 24th. So it's not exactly happening right now in terms of the selling from the so to speak, from the index itself, but people are preparing for the fact that there's going to be a little bit less index flow into those names. And to me, it's just reflective of obviously the place that this market has taken.
At 11 a.m. Eastern Time, we expect New York Fed inflation expectations. We also expect comments from Fed's Daily, who's discussing inflation and bank supervisor.
Kind of redistribute. So you're not going to know exactly how much selling is going to happen in those stocks at the time of the rebalancing for a while, but clearly people are getting ready.
Is there something magic about 48?
We also expect comments from Fed's Mester, who's speaking on the economic and policy outlook in a virtual event. Text is expected with a Q&A. And Bank of England's Governor Bailey, who's delivering a speech at the Financial and Professional Services Dinner. The Bank of England will release its text at 11 a.m. Eastern Time.
Threatened to sort of consume the whole index. And so they really wanted to have rules. If this was going to be a traded index and you're going to have an ETF that's going to be diversified by rule, you can't let it get too skewed in one direction. My guess is they don't want, a handful of stocks being half the index. And so you sort of draw the ceiling at 48 and say that's where we go from here. But it also does point up, as we've talked about, David, if you're a mutual fund, an actively managed mutual fund, I think there's a 5 and 25 rule. David Costin's talked about this. Top 5 holdings can't be more than 25% of the fund. Well, right there, you're automatically underweighting the biggest stocks in the index.
And I mean, where are we in terms of the weight that those? I know what Apple is specifically, but is it possible to know those 5 in the S&P as well?
In the S&P, I'm trying to think of it. I know it's basically 15% for Apple and Microsoft alone, or 14 to 15% for those alone, and it does kick you over. Probably 25% if you do the 6 or 7 that we talk about all the time.
Yeah. Which means what? I mean,
Well, that's the question. Is it a good? Is it a bad? Is it a neutral? Is it just the way it is? I mean, clearly it means if you own the index, you've gotten the benefit of not selling the winners. I mean, I think that from an investment behavior point of view, that's one thing the index does is make sure you don't sell the winners. On the other hand, maybe you have a lot of your eggs in a single basket, or maybe vulnerable to some downside volatility on that front. And to me, it's also a winner-take-most economy. It's the way the market's viewing it, and the equity index reflects that.
I mean, it also means that the S&P is up 15% year to date, and the Dow's up 2%.
Exactly. Yeah, the Dow skewed the other way, different type of stocks, different weightings, and is not participating.
So we got excited about the broadening. The Bulls got excited about the broadening out in June. Is that?
It's
continuing?
happened. I mean, look, the equal-weighted S&P I think is up 4 to 5% this year. That's not a bad half year. By most standards.
By most standards,
unless you're going up against 15.
And again, back to the original point. Other than Meta, mega cap tech is down today.
Yeah, Meta seems to be just moving on its own news dynamic.
Yes.
Yeah.
Zuckerberg, the favorite in the big cage match coming up. Yeah. Also on Threads. All right, Squawk on the Street. We'll be back right after this. Don't go anywhere.
1 minute remaining. I'll lead with the New York Fed inflation expectations. Ten seconds. New York Fed 1-year inflation expectations fall to 3.8% versus 4.1%. New York Fed 3-year inflation expectations steady at around 3%. New York Fed 1 year ahead expected inflation at the lowest level since April 2021. And New York Fed June home price expectations rise to 2.9% versus May's 2.6% expected gain. New York Fed 5 year ahead expectation inflation at 3% in June versus 2.7% in May. New York Fed home price expectations the highest since July 2022. New York Fed households' view on personal financial situations improved in June, and perceptions of credit access improved in June. Expectations for gasoline prices fell in June.
Partners Executive Chair Alan Schwartz, as bank results this week signal the start of a make-or-break earnings season, plus his take on Yellen's trip to China.
BMO's chief investment strategist Young
Fed's Mester says I'm waiting for passive tightening risks, longer high inflation.
Coming later on this week, we'll get his warning on the Fed's excess tightening.
Later, Satori Funds' Dan Niles as the street turns bearish on tech in the second half.
Fed's Mester says interest rates need to move up somewhat further.
Meanwhile, markets here seeing some weakness in
Fed's Mester says we will need to hold rates at peak for a while.
Some of that underperformance this morning, but for the most part, sort of on watch for the data.
Fed's Mester says raising rates again will reduce risk of more action in the future, and Fed policy is less restrictive compared to history. The Fed will need to tighten somewhat further to lower inflation. Fed rate hikes have been moderating economic activity, and business leaders' fears of recessions have declined. Demand for labor is still outstripping supply, and Fed's Mester says wages pressures remain too high to get inflation back to 2%. Fed's Mester says core inflation gains too high and are too broad-based. Fed's Mester says the Fed is closer to the end of the tightening campaign than its start, and inflation is stubbornly high and stalled progress on core prices. Supply chain disruptions have eased, and the economy has proved stronger than expected.
Well, because Powell has said 2 more.
Bank of England's Bailey says my preoccupation at the moment is inflation, and inflation is unacceptably high. We must bring it down to 2% target, and the UK needs sustained growth in the supply side. Bank of England's Bailey says headline inflation is set to fall markedly over the remainder of the year, and wages and prices are still rising too quickly. Bank of England's Bailey says we should not use enhanced digitalization materially to shift the mix of commercial bank and central bank retail money towards the latter. And Bank of England's Bailey says the level of economic activity has failed to grow beyond its pre-pandemic level on a sustained basis. The UK economy has shown unexpected resilience in other ways, and our work on retail CBDC does not alter our commitment to physical cash.
We do think it's starting to be a show-me market.
Bank of England's Bailey says both price and wage increases at current rates are not consistent with the inflation targets, and some of the previous tightening has yet to hit the UK.
Now, that if the Fed has to ratchet rates up, it's talking about 2 more times, but 2 more times is just a current baseline. And so far, the Fed has been surprising to the upside. So if that continues, that would be very difficult for the market. So certainly the inflation data, the expectations for what the Fed is going to do, if wage growth is going to be a problem.
Bank of England's Bailey says the main motivation for a retail CBDC would be to ensure the public has central bank money that can be used in their everyday lives. And UK underlying inflation pressures are set to recede. Bank of England's Bailey says it's crucial that we see the job through.
It's really a very data-sensitive market right now, we think.
Yeah, and that leads us, bank earnings starting on Friday. A lot of people have been already watching.
Bank of England's Bailey says the Monetary Policy Committee is watching wage and inflation and price data.
And loan loss provision. Do you think that's going to be reflective of the environment you're talking about beginning Friday?
Fed's Daily says the U.S. economic momentum continues to surprise us.
The big question is how much credit in the economy is going to contract. And some of those markers that you talked about will imply how much banks might be pulling back. And that, again, it could be a bigger concern if those numbers are larger than people are expecting. So, again, it's going to be very much data-driven.
Bank of England's Bailey says UK headline inflation is set to fall markedly.
When we had strong economic data, if there's too much that's pointing in the direction of tightening credit conditions, the Fed having to raise rates too much, and this idea
Fed's Daily says inflation is printing too high and needs to keep raising rates. Bank of England's Bailey says UK food prices are likely to fall this year, and Fed's Daily says in the context of that momentum, there's more we need to do to raise rates.
The credit situation.
Fed's Daily says also we need to balance against risks. Bank of England's Bailey says the UK economy shown unexpected resilience to shock.
More pronounced credit crunch. And we don't say it's not necessarily happening.
Fed's Daily says we are likely to need a couple more rate hikes this year.
Yeah, it takes a while to play out, and I think the reality is we don't know, and it's two-pronged, right? It's partially on the side of lenders, but also
and at 11:15 a.m. Eastern Time, we get comments from ECB's Herodotu, who's speaking at the Economists Eastern Medium Business Summit.
For certain expansion. So this is something that takes some time.
Fed's Daily says we need to be data-dependent to make policy.
Read into certain data points.
Bank of England's Bailey says Bitcoin-type crypto best seen as extremely speculative assets.
Again, it's something that remains a risk out there in the marketplace, especially as the Fed is looking to raise rates.
Bank of England's Bailey says bank resolution strategies must avoid any uncertainty over what will happen to customers' money.
Last week was some of the prices paid.
Bank of England's Bailey says cash is here to stay despite digital currency.
And some of the work that came out of it was that it's reflective of environments, at least in the past couple of decades.
Bank of England's Bailey says this doesn't automatically mean all money in the UK banks is guaranteed, but we must ensure the rules keep up to date.
Well, we do think that
Fed's Daily says the risk has become more balanced.
Good, but we think that takes time to play out as well. And the
Bank of England's Bailey says stable coins are not robust and do not meet standards of safe money.
To ease off a bit, or at least pause and maintain the status quo in the coming months? Or does that just take more time to play out? And is the Fed a little bit impatient, wanting to bring inflation down more quickly than it's coming down in a natural way? So there are a lot of questions here because the dynamics could take longer than people are thinking and longer than we've originally thought they would take. And there are some indications that the Fed is a little bit impatient here and wants to bring inflation down more quickly.
So what do you do as a chief investment officer? I mean, nobody wants to miss, right, the end of the positioning into the end of the tightening cycle. Are you saying it's too early to do that?
Fed's Daily says today, with labour markets still strong, inflation is high and risks of doing too little are outweighing risks of doing too much.
Thinking of the fixed income side, we think it's probably worth waiting a bit.
Fed's Daily says it's appropriate to slow the pace of rate hikes.
In terms of overall positioning, we think we still want to take a balance.
Bank of England's Bailey says money held on deposit in a failed bank above £85,000 may not retain all its value.
But on the flip side, if the market starts pulling back severely, it probably is a time where we can become a little bit more optimistic because we do think those forward-looking measures of inflation are going in the right direction. And
Fed's Daily says the risk of doing too little on rates outweigh doing too much.
To the markets, and that could come in 1 month, 2 months, 3 months, but we don't want to get overly pessimistic if the market pulls back on some bad data, because we do think it will be a very data-sensitive market in the coming weeks and months here.
It's interesting, even a lot of the macro strategists who've been talking about, in general, a range for the second half of the year and even into 24, they do add a caveat, and that is that the generative AI story could pick up some steam. I mean, maybe you get some follow through on guides, maybe not NVIDIA-like, but something in that neighborhood that could allow for further upside. How much are you allowing for something like that to happen?
That is a wild card here. We do think it does add the AI theme and the overall tech enthusiasm that engenders. We do think that does add an element of a backstop or willingness to come back into the market, or at least into some of those technology names on pullback. So it is quite a tug of war right now in the marketplace. We do think that is a very strong and lasting theme that does add some underlying bid to the markets. But again, we do think that we need to see inflation and some of those measures come in better, along with a stable earnings season. So we do think it's data sensitive, but we don't think the pullback would be too severe if it happens, if data doesn't come in that strongly. So that's why I think on a pullback...
Kuwait's oil revenues at $17 billion in 2023 to 24 draft budget, an estimated decrease of 19.5% compared to the previous budget, according to a report.
We'll see what the next 6 months bring. Thanks so much. Good to see you.
Thanks, Carl.
Yeah, we're 1.3%.
And that's 11:15 a.m. Eastern Time. We expect comments from ECB's Herodotu, who's speaking at the Economist's Eastern Medium Business Summit.
Visit to that country in the last few weeks, a list that includes CEOs like Tim Cook, Jamie Dimon, Secretary of State Anthony Blinken, and Elon Musk. Our Eunice Yoon is in Beijing with what we learned over the weekend, Eunice, and I'm particularly interested to hear how it's being received in China.
Oh, it's being very, very well received in China. The secretary had left Beijing with U.S.-China ties, in her words, on sure footing. And after at a press briefing at the end of her multi-day trip, the secretary said that over 10 hours of discussions with President Xi Jinping's new economics team, she attempted to reassure her Chinese counterparts that U.S. restrictions for national security would be, quote, highly targeted, that the U.S. didn't seek to decouple but to diversify, she said, supply chains, and that a Biden administration goal to really pursue open dialogue would benefit both sides. This is what she had to say.
We want to open up channels so that they can express concerns about our actions, and we can explain and possibly in some situations respond to unintended consequences of our actions if they're not carefully targeted.
This stream is sponsored by TickStrike. TickStrike allows you to actually hear order flowing futures, forex, and stock instruments. Get a free trial at tickstrike.com.
Of the new economic team, many of whom are unfamiliar in the West and by Treasury. The Chinese state media has been describing the exchanges as professional. But despite all the pleasantries and happy talk, the Chinese government has suggested that their position is still unmoved. In fact, the finance ministry today said that China now requires U.S. action on Beijing's concerns. Those are the next steps, which would include canceling additional tariffs on Chinese goods, ceasing the, quote, suppression of Chinese firms via sanctions or export curbs, and also lifting the ban on Xinjiang products. But whatever happens in official circles, Sarah, to your point, the reaction among the public has been very, very welcoming. She left a very good impression. In fact, there was one restaurant where she ate that decided to create a God of Money menu based on the dishes that she ate, and it's to honor the Treasury Secretary.
Fed's Daily says we need to be resolute and thoughtful.
We don't use that term officially, but it would be a great title to have. The other thing I noticed today, Eunice, was some ongoing dialogue regarding China-Russia trade commitments. And I wonder how that's playing as we see these ongoing tensions geopolitically regarding Ukraine.
Well, China continues to repeat that it wants to maintain a very close friendship with Russia. It hasn't yet condemned at all the invasion there. So, as we see, the U.S. continues to pressure China, very concerned. In fact, the Treasury Secretary had said that she brought up the invasion of Ukraine as well as China's economic ties with Russia in some of the conversations, warning them about in any way supporting more giving more military support to Russia or to Russia against Ukraine. So that obviously part of the conversation and not something that we're seeing really changing in terms of China's position towards Russia at the moment.
Shortly expecting comments from ECB's Herodotu.
Mushrooms from southwestern China, as well as other specialty dishes from Yunnan.
Love it.
They're really good. It's a great restaurant.
Do they deliver? That's what we want to know, right? Eunice, thanks. Eunice Yoon in Beijing tonight. Meantime, Guggenheim Executive Chair Alan Schwartz is going to join us after the break on what we need to see from the banks on Friday, plus his outlook for deal making in the second half.
And we're looking ahead to earnings. Pepsi, Delta, Wells Fargo, and Citi among the names that will be reporting this week. We'll help give you a preview. Stay with us. Dow's hanging on to about 100-point gain. It's half of what it was. The S&P has gone negative, joining the NASDAQ comp. We'll be right back.
According to the report, Kuwait's 2023 to 24 draft budget based on oil price assumption of $70 per barrel. Fed bids for 6-month bills total $4.6 billion. Fed bids for 3-month bills total $5.1 billion. Fed's daily says there are longer lags than we assumed.
After last week's economic data, nearly 9 in 10 economists are now expecting a 25 basis point rate increase next week from the Fed. And our next guest is in that camp. He sees it as the end of this hiking cycle, but that quantitative tightening, what we've seen on the balance sheet, will continue, likely keeping future raises on the table. Joining us now is Guggenheim Partners Executive Chairman Alan Schwartz. Alan, it's always good to talk to you. So you think we're nearing the end of this tightening cycle?
Well, yes, I think we probably are, but I don't think it means that we're going to then turn around and have an easing cycle. So let me give you a little background as to what we believed coming into this period. When we went back to when the Fed began raising rates during what my partner Ann Walsh and then my old friend Ed Yardeni later told me was a rolling recession. I thought that the delevering of consumer balance sheets that had occurred before that cycle started, as well as the change in age demographics that is very significant, would mean that rising interest rates would have less impact on consumption than it had in past cycles, and therefore that economic activity would stay positive longer than many people expected at that time. And so now that has occurred. And as we sit here today, while consumers reduce their exposure to rising interest rates, the financial system took on a tremendous amount of more exposure to that duration risk or rising short-term interest rates, but it takes longer to flow through the system. So the first wave of that, obviously, as my partner Jim Milstein was advising the FDIC on Silicon Valley Bank, First Republic, was the massive wave of exposure that those banks took as lenders, and therefore their marks on their positions in high grade was more than their capital, and that's why the FDIC had to resolve that. Mm-hmm. So that has settled down. The deposit surge out of banks or leaving the banks has settled down. But what we haven't yet seen is, as I say, while consumers reduce their exposure to rising interest rates, the whole financial system dramatically increased that exposure. And we're just beginning to see some of that exposure really hitting a real tightening of credit conditions. And I think, therefore, I just want to say that we still think, while we thought it would take longer to see a recession, we still think there's a recession on the horizon.
At 11:30 a.m. Eastern Time, the U.S. sells $65 billion in three-month bills, prior bid cover 3, and a prior high yield of 5.23%. The U.S. sells $58 billion in six-month bills, prior bid cover of 3 to 2, and a prior high yield of 5.26%.
But I think they're going to stay on pause for a while until they see how inflation settles out over a period of time.
So just explain more about what you're expecting for the financial system, because it sounds like you do not think the aftershocks of SVB and tightening have fully played out there.
Yeah, I think it's, yes, the SVB was just one part of it. I do think that people will be paying attention to bank balance sheets, especially regionals, less the SIFIs, and that they all had a lot of exposure, but it's really the first wave, as I say, was lenders' duration
Fed's
risk.
Daily says it's too early to declare victory on getting demand in balance with supply.
I mean, an enormous amount. And so now the question is, as those loans start coming due, whether the borrowers who, now would have to pay much higher rates for the same loans that they're paying off will be able to do that.
Fed's Daily says we may end up doing less or more than a couple of rate hikes this year, depending on the data.
Incentive to be lending, and so we're just beginning the tightening of those credit conditions, and it's very hard to predict where it can go until you see what kinds of impediments you run into in the system as it plays out.
So what has all this meant, Alan, for what you're seeing at Guggenheim? What are you seeing in the investment bank? Are there green shoots as we near the end of the tightening cycle, or people waiting it out? Because as you say, it doesn't look like we're going into an easing cycle anytime soon.
Right. So I think that, it affects very many different sectors in a very significant way. So I think over in the financial side, as I say, the amount of floating rate loans that were issued and put into CLOs, et cetera, like that, they're going to be coming due. A lot of them were single B. You're starting to see some downgrades in those. And how that's going to play out, as I mentioned, my partner Jim Milstein, our restructuring and advisory team, our capital markets advisors, is going to have a lot of work having people think ahead. Now, there's significant capital on the sidelines, but how that comes together and whether it opens up the markets for the more leveraged parts of the market, we're going to have to wait and see. At the same time, investment grade companies who are many times priced out of the market when people were able to use those low interest rates to buy assets, that now those corporates are coming back and looking at the opportunity to do some M&A as the buyer of, maybe last resort, you might say. So you're seeing an awful lot of corporates looking in to see if they can now do some of their M&A that they've been waiting to do and have been priced out. So we'll see how that plays out.
Where is the opportunity for you in this kind of environment where you're expecting the recession, right, and still worried a little bit about the health of the financial sector, but at the same time, the consumer's not in bad shape?
Right. Well, the consumer is not in bad shape in general. You're starting to see some of that now. Younger consumers, particularly, started to take on a lot of debt in this cycle, even if they didn't have as much coming in. So you're starting to see some pressure there in those, credit card debt and others in the younger demographic. So that could have an impact on the economy as well. But we have to, we have a broad-based firm. We have M&A and capital markets and restructuring, advisory, et cetera. So as I said, I think helping companies manage their balance sheets will be a big opportunity. Bringing M&A opportunities into as one of the ways to manage exposure. Sometimes we're seeing that we can bring in corporates that have strong balance sheets, get a chance to merge with companies that may be having strain on their balance sheets. So there's a lot of M&A opportunity. And there's also, there's obviously capital flowing into certain sectors. You're seeing AI and its impact, data centers and places like that. So we're fairly, have a fairly significant infrastructure build. And one last area I've talked about before on CNBC a long time ago, we've been focused heavily on sustainability. And we believe there's going to be a major, major wave of investment spending on decarbonization and clean tech and all of those things. And what I think is important about
At 11:30 a.m. Eastern Time, the US sells $65 billion in 3-month bills, prior bid cover of 3-0 and a prior high yield of 5.23%. And the US sells $58 billion in 6-month bills, prior bid cover of 3-2 and a prior high yield of 5.26%.
What's good for the economy, or we should be investing capital in what's good for the environment. Actually, in today's world, they are exactly the same.
What does that mean in practical terms? What kind of investments do you like?
Oh, well, you're seeing a lot of infrastructure in, step one in the extension, especially with the IRA coming in. Infrastructure in, renewables, in energy storage, in decarbonization, direct air capture and other, carbon capture things. There's also going to be a wave. We're working with a number of people in government to try and we need to get the SMRs, advanced nuclear, started, because there could be a big wave in advanced nuclear. And, liquid hydrogen. There's just a lot of things coming, they're coming out of the lab and into the market now. And over time, there's going to be a big global wave of capital into those technologies. And that's exactly what the global economy needs to both reshore.
Fed's Daily says one lesson learned from the last cycle is that the Fed could raise rates even if the balance sheet is still expanding.
As well as bring some of the populations of the less developed world into a global economy where the developed world economies all have peaking and declining population growth.
Alan, thank you. Always interesting to hear from you and get your thoughts on the environment and the opportunities. Alan Schwartz,
thank you very much. Nice to see you.
Guggenheim's Executive Chair.
Meantime, China just posted the lowest CPI number it's had in over 2 years. Our story abroad and the close of Europe is coming up next.
Plus, watch out, Estee Lauder. Citigroup opens a negative catalyst watch on the stock, saying it could underperform on earnings. Shares are up, though, a little bit, less than 0.5%. We're back in a moment.
Shortly expecting the results of the 3- and 6-month bill auction, I'll lead with the 3-month bill bid cover ratio.
Welcome back to Squawk on the Street. I'm Bertha Coombs, and here's your CNBC News update. Flash flood warnings and flood watches are in effect today in the Northeast. Meteorologists say thunderstorms will bring heavy rain to much of New England and northeastern New York. It comes after New York's Hudson Valley saw close to 10 inches of rain Sunday. State officials say one woman died when she was swept away by flash flooding while trying to evacuate with her family. Dutch Prime Minister Mark.
And we in government, working with our partners on the ground, have to work with our communities to build up resiliency, to be prepared for the worst because the worst continues to happen.
Dutch Prime Minister Mark Rutte says he will not run for a 5th term in office following the collapse of his government. He handed in the resignation of his cabinet Friday, bringing an end to the country's fragile 4-party coalition government. And the New York Times is disbanding its sports department. But hold on. The paper announced today that it will rely on The Athletic for coverage, both in print and online. Times says there are no layoffs planned in the 35-person department. I actually kind of like The Athletic, Sarah. It has this nice kind of liveliness to it.
Yes, it's useful. Good news for those that follow sports. Thank you, Bertha. Bertha Coombs. Is it time to dump tech? Not yet, says Dan Niles. His reasons to get bearish on tech.
3 to 12, 3 to 12, high yield, 2.8%. Sorry, high yield, 5.25%, 5.25%. 6-month bill bid to cover ratio 2 to 93, 2 to 93. High yield 5.27%, 5.27%. So the US sells $70 billion in 3-month bills and awards 33.64% of bids at high. And the US sells $63 billion of 6-month bills and awards 92.95% of bids at high. Fed's Mester says it's too early to say the neutral rate level has shifted much.
The Fiverr freelancer.
Couple hours into trading, S&P really nailed at 4,400. Let's get a look at what's moving with Bob Pisani. Hey, Bob.
We are over 4,400, Carl. You're right. Remember, the old closing high, 4,458. So only 50 points essentially away from a new closing high if we maintain that. So I've been traveling a lot. I can tell you the hotels, the restaurants, cruise lines, all packed. And we're hitting new highs on some of the big travel names today. So here's Norwegian Cruise Line. Ever since, the end of May, beginning of June, that jobs report, June 2nd or 3rd, these cruise lines, all the travel stocks have been moving. We've got new highs today on
This stream is sponsored by To The Tick. Get free daily pivot points, Fibonacci, and market profile levels by signing up at tothetick.com.
Doing very, very well this quarter. Unfortunately, on the other end, on the cyclical end, on global fertilizer names, for example, material names, and commodity names, energy, not much help here at all for the overall market. Here's Mosaic, one of the big global material names that I watch. One decent day on Friday on the jobs report, and then just essentially nothing. Most of these sectors are down, 16, 17, 18%. Most of the energy names are also down on the year. So commodities have not been performing very well, and obviously some of this has to do a little bit with the slowdown in China. Want to mention on the IPO and direct listing business, we may have a nice one down here tomorrow. We're going to have perhaps the first direct listing for the year. This is Surf Air Mobility. They're supposed to be pricing tonight for trading here at the New York Stock Exchange tomorrow. We'll see if that actually happens. This is an electrified aircraft company. And remember here, Sarah, we've got a direct listing. They're selling existing shares directly to the public, no intermediaries. So we'll see if that happens tomorrow. And of course, I'll be here covering that. Sarah, back to you.
Yes, we can't wait. Thanks, Bob. Bob Pisani. Let's turn now to the notes catching our attention this morning. Boatload of bearish sentiment on what to expect in the second half. You've got Barclays saying it doesn't see the tech-fueled rally broadening.
ECB's Herodotu says policy tightening is only a tool to fight inflation.
Struggles to recommend an overweight in the tech sector for the second half. And then this from Citi, U.S. outperformance may go on pause despite a solid first half. All of this in line with our next guest's outlook, predicting a down market with negative risk-reward between now and year-end. Joining us is Satori Fund Manager Dan Niles, founder as well. Dan, it's always good to hear from you. Thanks for joining us.
My pleasure.
So were you surprised by the first half outperformance in tech and the overall market before we get into the outlook?
Absolutely. I thought so if you go back to what we were saying, when you had all the bank failures, our view is the market would rally just because the government would step in. And we've seen this since the global financial crisis. Of every time there's a problem, you get tons of stimulus, and you got about a $400 billion expansion in the Fed balance sheet.
Fed's Mester says, I don't think rates are that restrictive so far.
4,200. But one big thing happened was May 24th, NVIDIA reported guided revenues 50% above consensus for the next quarter. I've been doing this for 30 years. I've never seen that kind of revision up in a big cap company. And so at that point, you had a 7%.
ECB's Herodotu says high interest rates won't be permanent.
Since May 24th. And, the market's gone to 4,400, which is well above the 4,200 that we thought it would peak out at. And so, yeah, it's definitely been surprising. But, to some extent with NVIDIA and what happened, it makes sense because, people love stories. They want to chase the next greatest thing. And so in that regard, I guess it makes sense.
Fed's Mester says, I haven't seen balance sheet runoff causing market stress.
Rally, it definitely broadened out on this idea, Dan, that growth
and ECB's Herodotu says it's unlikely to return to negative rates in the future.
Inflation is moderating, and that's a good sort of recipe for stocks and earnings expectations.
Well, yes and no, because remember, NVIDIA's numbers went up a lot. But we're going to have to see how everybody else.
ECB's Herodotu says inflation is more detrimental than high rates.
Like Accenture, supposed to benefit from companies consulting over AI. The numbers went down. Micron, you need high bandwidth memory. They reported Ford numbers went down, stock went down. Cynics, same thing. So you got to remember, NVIDIA is in a special class because they basically have a monopoly right now on how to enable AI. And investors think, well, all these tech companies are going to benefit. Well, the money spent on NVIDIA is coming out of some other budgets. It's not like the economy is going gangbusters and companies have tons of money to spend everywhere. It is the year of efficiency, to quote Mark Zuckerberg, for a reason. And you're hearing that from every company. So this earnings season is going to be very interesting because I think you're going to see some companies do well off the AI theme. But I think you're going to see others go, yeah, our AI business, just like Accenture, just like Micron, just like Synnex, that part of the business is doing great, but all this other parts of the business is slowing down, and so our forward numbers are coming down. And I think that's why this earnings season, you're going to see a lot of stocks getting hit pretty hard off of it, and others confirming that they are actually doing well off the AI theme.
So you don't think, I mean, with consensus down 9 year on year,
IEA
Goldman's
Chief
take is that we're
Birol
gonna
says
drop
oil
earnings.
demand from
You're
China
in
and
that
developing
camp?
countries is set to be
No,
strong.
I'm not in that camp. I mean, I think, the economy is like a battleship. We've had 10 raises so far. I think we're going to have another raise at the end of this month by the Fed, and then one after that at least, at a minimum. And so it takes a while for that to filter through the economy. And don't forget, those bank failures just happened in March. And so lending standards have tightened, but it's going to take some time for that to work its way through. So the bank earnings coming up later this week, actually, I'm going to be watching very closely because unlike the rest of the market, the banks are trading about 30% below what their historical, average is. And we all know numbers are going to come down, right? Net interest margins are going to get compressed. Loans are going to be harder to get. And, investment banking fees obviously down. And so estimates are going to go down. If the stocks go down, despite them being at a 30% discount to what they normally trade at,
Fed's Mester says, I expect housing-related inflation to ease.
and how high or low expectations actually are.
Yeah.
And so I think with the tech companies that have been on a tear ever since NVIDIA reported, there's going to be some interesting puts and takes here in terms of, well, AI is helping this, but maybe the economy is hurting that. And if you've got a very high PE ratio, that could be a severe problem. I mean, we like Meta. That's our, best pick. It was one of our top 5 picks coming into the year because you've got, high single-digit revenue growth. You've got a 23, 24 PE against the market at 20 times. That's really interesting. You compare that against an Apple growing revenues at 1% to 2% at a 33 PE, that's a lot more challenging. And so I think valuation's the piece that nobody's really focused on. And I think at these levels, especially with the three-month T-bill at 5.4%, guaranteed, risk-free, against the market where if you take the inverse of, where the S&P is trading at, which is just over 20 times, that's less than 5%. The T-bill looks pretty interesting, especially if rates are going to go up even more from here.
Dan, thanks for coming on, summarizing your second half views. Appreciate it. Always good to hear from you, Dan Niles.
Thank you.
Last year, our top state for business was North Carolina. Your next clue on this year's winner is coming up after the break.
Plus, watch shares of Fox. Wells Fargo goes underweight on the stock this morning over continued cord-cutting pressures and declining viewership. Shares down a little less than 1%. Don't go anywhere.
Fed's Mester says last service's inflation print was good, but just 1 month.
The big reveal of our annual top states is tomorrow. Our Scott Cohn joins us now with some more methodology behind this year's ranking and another hint, please, Scott.
Hey, Sarah, we've been doing this since 2007, and it is now officially a tradition that at some point...
Fed's Mester says, I had favored a June rate rise.
Kayak or some other watercraft and see if he drowns. So far, so good. But there is a serious study behind all of this, and for 2023, here's how it works.
We rate the states based on what the states are selling. This year, with people in such short supply, everyone is talking about their workers. So workforce carries the most weight. Where are workers moving? Where are they the most productive and the best trained? Next, infrastructure with $1 trillion in new federal money, roads and bridges, ports and airports, broadband, sites for development. We look at the economy, which states are growing, life, health, and inclusion, the cost of doing business, technology and innovation, business friendliness, education, access to capital, and the cost of living.
You can read more about our methodology on our special website, topstates.cnbc.com. And tomorrow we will reveal America's top state for business. So where am I? Here's another hint. Beat the rush. Beat the rush. If you're with Scott Cohn in a kayak, you will not beat the rush. Again, topstates.cnbc.com. More hints throughout the day, and you can read all about state competitiveness at that website, topstates.cnbc.com. Guys?
Beat the rush. Any thoughts, Sarah? Beat the rush. Scott,
Looks like there's no rush there.
Whoever writes the clues needs to be a little more generous.
That would be me. Actually, me and my wife. We like it. That is another. That's a ritual now. We work on the clues together, and I think they're pretty good.
We'll see.
Tricky.
I do wonder, Scott, on a serious note, the way in which certainly rhetoric about business at the state level has changed. You referenced this in the last hour. Has changed the methodology overall. I mean, how governors see pro-business policies has evolved in the last couple of years.
Absolutely, it's evolved, and it's so different from state to state now with the culture wars going on, and we've tried to address that. What we generally try and do is we focus on results. Which states are gaining the most workers? Where are crime rates higher? You can look at life, health, and inclusion, which is an important category, and increasingly so because the states are talking about it. And you can look at kind of empirical things like state laws and things like that. So we try and keep it as objective, I should say, as we possibly can, focusing on results. And again, as you saw a moment ago, it's based on, the categories are weighted based on what the states are talking about. So we're trying to grade states basically on their own report card.
Scott Cohn, not only talking about the methodology, but see how he manages to stay in the shot.
Where do you think the cameraman is, or woman, in that shot? Because it's awfully steady.
Fed's Daily says credit tightening from March banking stresses is probably less than the quarter point to 50 basis point rate hike I have thought.
Looks like you're in the middle.
Just be careful. Don't tip on live TV. It's Scott Cohn.
The rush, like for shopping, when you leave a concert early. I don't know. There's something I don't know meaning in that phrase.
When we come back, Sarah Silverman suing Meta and OpenAI over copyright infringement. We'll get an explanation on today's Tech Check next.
But first, watch shares of Schwab as well this morning. Upgrade from JMP today, calling it an interesting trade into earnings season. Stocks up more than 1%. We'll be right back.
Fed's Daily says credit shocks have a lag, and we could still see it in the next coming months. At 12 p.m. Eastern Time, we expect comments from Fed's Bostic. Fed's Daily says community banks are tightening more than bigger and regional banks, but it's hard to know how much more. Fed's Daily says we are at the last part of our rate hiking cycle.
Hollywood writers and content creators are now leading the charge against AI over copyright infringement. That is the focus of today's Tech Check with Deirdre Bosa. Pretty interesting case here, Dee.
Yeah, good morning, Carl. It is one of the big early risks or questions around generative AI is that copyright infringement. And as you said, Hollywood continues to lead the fight on that front. The latest, comedian Sarah Silverman, with a few other authors, are suing OpenAI and Meta, each over claims of using their content without permission to train chatbots. They allege that the company's large language models were trained on their books without the proper authorization. And of course, this isn't just an issue for Meta and OpenAI, but it raises questions about the limits of copyright itself and how chatbots can leverage content when so much of the internet is copyright protected. In other words, the copyright lawsuits, they're probably only just beginning. RBC writes, we are keeping an antenna up for data points like these representing downside risk relative to the current level of generative AI hype. And guys, it does seem like the risk antenna is up more broadly on Wall Street when it comes to this AI hype cycle, or at least more than it has been. Look at ChatGPT monthly traffic. It fell for the first time ever in June, according to SimilarWeb. Unique visitors declined, as well as the amount of time users spent on the site. And just look at the performance of the AI-exposed megacaps over the last month. It's been different than the first half of the year. Google, Microsoft, AMD, they have underperformed. And even NVIDIA's run, it has slowed in July. So maybe some of that halo effect coming off. And guys, just as we're getting into second quarter earnings season, a lot of the Wall Street notes I've been reading this morning talking about how AI may not be relied on at the same way as it has the last quarterly earnings reports.
Just trying to understand the allegation here. Do we know what Sarah Silverman claims they've used? What kind of material? Is it quotes of hers and how they used it?
She says it's her entire book. And the issue is that, you know, there's sort of these summary websites on the internet that take passages from it. And then so she says that aren't authorized to take passages. So she says then that ChatGPT as well as Meta take some of that, in separate lawsuits sort of, take some of those summaries to basically summarize her book. And that's what the other authors are claiming as well.
All right, that's a whole can of worms, I guess.
It is. It's just the beginning, right?
Yeah.
I mean, there's going to be more and more like these. And it's starting in Hollywood, but you can imagine the business case as well, right? If you have particular models that are used in open source, large language models, you have really sensitive data that comes from companies, not just books.
Yeah, makes sense. Thank you, Deirdre. Deirdre Bosa, one to watch. A new survey on the street says 1 in 6 asset managers may be gone by 2027. We'll tell you why after the break.
Sponsored by Comcast Business, powering possibilities.
With your hearing, if you start having a little trouble, you're concerned that it's going to cost you money.
To this day, I only paid what I had to pay for the device. I go back.
At 12 p.m. Eastern Time, we expect comments from Fed's Bostic.
By not having hearing aids.
We'll find you a hearing aid that fits your lifestyle and budget at one of our over 1,500 locations.
Call Miracle Ear at 1-800-MIRACLE and schedule your free no-obligation hearing evaluation today.
Your shipping manager left to find themselves, leaving you lost. You need to hire.
I need Indeed.
Indeed you do. Indeed Instant Match instantly delivers quality candidates matching your job description. Visit Indeed.com/hire.
My plane has mechanical problems. I'll try to get there as soon as I can.
Breakfast looks delicious, as always. Having a chauffeur car plane side helps keep me on schedule. Hi, Jeff.
With all the plane shortages, did you have trouble finding one?
I never have any trouble. I simply pick a plane, pay, and I'm ready to badge it to my destination.
Are there any taxis around? I'm really late for my meeting.
Do we have a deal? Missed you at the meeting today. Badge it and don't miss out on the most important moments of your life.
Your return flight comped when you badge it.
Private market alternatives help you outperform the traditional portfolio by up to 40%. Meet Yield Street, the leading private market investment platform with 10 highly vetted asset classes. Diversify with alternatives. Open an account at yieldstreet.com.
We planned well for retirement, but I wish we had more cash.
You think those two have any idea that they can sell their life insurance policy for cash, so they're basically sitting on a gold mine? I don't think they have a clue. That's crazy. Well, not everyone knows Coventry's helped thousands of people sell their policies for cash, even term policies. I can't believe they're just sitting up there, sitting on all this cash.
If you own a life insurance policy of $100,000 or more, you can sell all or part of it to Coventry, even a term policy, for cash or a combination of cash and coverage with no future premiums.
Someone needs to tell them that they're sitting on a gold mine and you have no idea. Hey guys, you're sitting on a gold mine.
Do you hear that?
I don't hear anything anymore.
Find out if you're sitting on a gold mine. Call Coventry Direct today at 800-571-7900 or visit coventrydirect.com.
CNBC. Live ambitiously.
Welcome to the closing bell. Let's get into the market right now.
Breaking news, market moves. Scott Wapner from the NYSE. Closing bell weekdays 3 Eastern, CNBC.
Those tech gains we're talking about in the first half largely sparked by AI enthusiasm, but could AI also soon be impacting the way you invest? Our Julia Borston has some details on that. Hi, JB.
Well, Carl, no industry is immune from the impact of AI, and now it is starting to disrupt financial planning. VCs have been pouring money into AI-driven personal finance tools. Over $1 billion invested between 2019 and 2022, according to PitchBook. Investing platform Public, which has over 3 million users, has a new AI research assistant called Alpha. It analyzes public filings and earnings calls to answer investors' questions about stocks, ETFs, crypto, and the like. Questions which would otherwise require expertise and extensive research to answer.
What are the pros and cons of this investment, right? So you hit that, and then Alpha basically gives you an answer.
The next iteration of Alpha will be hyper-personalized to explain how specific assets could fit into each user's particular portfolio.
Just makes that research so fast and so easy, and therefore also just kind of democratizes it way more for everyone, because you don't necessarily, have to know where to even find the certain information. You just fire away and ask.
Another startup called Wally
Shortly expecting comments from Fed's boss
through a conversational interface based on its tracking of its users' spending, bills, and budgets. And the big banks are increasingly focused on this space as well. CNBC has learned that JP Chase is developing a ChatGPT-like software service that uses AI to help select investments, and that Morgan Stanley is rolling out an advanced chatbot powered by OpenAI's latest technology to help the bank's army of financial advisors. So one key question here is, will these AI tools replace financial advisors? There are an estimated 330,000 of them in the U.S., or will it simply democratize access to their services? Sarah?
That is what we are all wondering. Julia, thank you very much. Julia Borston, it's a perfect setup to today's buzz on that topic. A new PwC survey predicting that robo-advice from financial services will manage $6 trillion by 2027. And 90% of managers believe disruptive technology like generative AI will boost returns, as Julia was talking about, and attract young investors. So what does it mean for the asset managers? Well, the same survey says 1/6 of asset or wealth managers will shutter or be bought by 2027. M&A is the big focus, with nearly 3/4 of the asset managers reportedly considering acquiring or merging with a competitor. So a lot of big changes and consolidation potentially coming out of this disruption in the space.
You got to think about the tech innovation that Julia was just talking about, but also the demographic issue as the boomers retire and eventually pass along whatever wealth they created in that massive wealth bubble.
It's also just a reminder that AI is transforming industries well beyond tech and semiconductors, the big banks, and potentially what that's going to mean to boost productivity and their bottom lines.
Yeah, pretty incredible. The judge is back. Let's get to Post 9.
Carl, thank you so much. Welcome to the Halftime Report. I'm Scott Walker, front and center this hour. The big week ahead for your money, a CPI. That's looming large. So is the kickoff to earnings season. We'll debate the road ahead for the markets with the investment committee. Joining me for the hour today, Bryn Talkington, Joe Terranova, Steve Weiss. Take a look at the markets. We have an interesting picture shaping up today. We have the Dow in positive territory still. S&P's gone negative. NASDAQ tried to go positive. It's now negative yet again. And maybe a large reason has to do with what you're seeing bottom of the screen. 10-year yield above 4% still. The 2 years at the highest level since 07. Got a bunch of Fed speakers, Joe, we're trying to get through today as well, looking ahead to earnings at the end of the week. The real test is going to be, can stocks withstand a period of higher interest rates again?
Well, we've been going through a period of higher interest rates since May 4th. 2-year Treasury is up 140 basis points in less than a little more than 60 days. So I think the market has already absorbed a significant move in yields. I think now the challenge is a lot of long duration strategies were being suggested. It was return, extend the duration once again. And I think those positions are being squeezed out. A lot of that's being reflected in mega cap technology underperforming today. And I think today is more about an equal weighted strategy, Scott. Having mean reversion.
Alphabet, Amazon, Microsoft, they're all weaker today.
It's not so much where I'd say, okay, it's technology universally, because if you look at the software ETF, the IGV, that's up 1.25%. You look at the SMH, that's up 1%. So I think this is concentrated towards mega caps, the equal weight strategy. But you're right. If we're going to continue to see yields rise, long duration strategies, which we talked so much about at the beginning of 2022, you don't really want to extend duration in that environment.
You know, Weiss, it's an interesting point. I mean, maybe tech is the perfect place to look to see if there's going to be a rollover of any kind if you do have rates, you know, continuing to creep up. There's some notes out today that are talking about that in part from a number of different places. Bernstein's Tony Sacconaghi, by the way, says we struggle to recommend an overweight in tech for the second half. Believe stock picking increasingly matters. Probably you agree with that, right?
Yeah, I do agree with it. But, you know, look, I think the biggest vulnerability is in the large cap tech, because that's where, on one hand, price vulnerability, because that's where the action's been, right? And that's where the major instances of multiple expansion have occurred. Less so. There's less. This sounds kind of strange, but it sounds kind of strange because they have the best balance sheets. They have the best growth outlook. If you take a look at, for example, what earnings forecasts are, earnings forecasts for this quarter look to be down 7%. But there are two sectors where it's really looking to be up, and that is in technology. So the strange thing is, though, they're vulnerable because of price, but not vulnerable to the fundamentals. So those are the concerns. So, yeah, if the market rolls over, that's going to be very painful for a lot of people.
Well, that's interesting, though, the way you bring that up. They're vulnerable because of price,
right?
Not necessarily for the fundamentals, which is why even as Citi today downgrades U.S. stocks, in part because they think that technology is due for a potential pullback, they'd be buyers on the dip. For the very reason that you're suggesting, because they provide all of the things you suggested, and the fundamentals line up as well. So maybe the price is a little ahead of itself in some of these names. You get a little bit of a correct there, if that even happens.
Right.
And then you're going to get buyers on the dip.
Right. And this is a binary week, right? I mean, you've got, forget about the Fed talk. You've got inflation numbers, and if inflation numbers show a real decline, then the market's going to take off. If the numbers, on the other hand, show, like we saw in, I think it was in Europe today, show an uptick, then you've got an issue with the market. So that's really, so it's binary based on them. What you're seeing today is really nervousness in that very leadership group that you're talking about.
The question is, Bryn, as to whether, you know, if tech falters, is something going to be there to pick up the slack? Barclays doesn't necessarily think so. They don't believe that broadening is going to happen to the rest of the market. The other idea that Bank of America puts forth today on the issue of rising yields, since 1980, they say, peaks in U.S. two-year yields have always been followed by a risk-off event within the next year or so. The full extent of damage is unknown until the peak in policy tightening is behind us. We are clearly not at that point yet. How do you see this?
Well, I mean, I think first of all that you can clearly have other sectors lead when tech is faltering. We saw that last year. If you actually didn't own tech, you did quite well. And so you can always have those opportunities where other sectors carry the weight. Last year is a good example of that. I think right now it's about digestion, and that, yes, we've had massive multiple expansion. And outside of NVIDIA, I'm really hard-pressed to see which companies in the tech side are really raising guidance. Sure, Facebook is cutting expenses, but who's actually raising guidance outside of NVIDIA? So I do think this will be one of the more important earnings seasons for tech companies, because as we're in this early AI stage of where we're building out the AI, this AI, whether it's sustainable or not, which companies are marketing AI and which are monetizing AI? And clearly, NVIDIA is monetizing it. We'll see who else is. I also think that the CPI print is probably going to be weaker than people are expecting, because just in the fact that the June of 2022 number is going to drop off. And so after this report, this is going to be the last report where you have this big one handle from last year. The June of 2022, Scott, was 1.2%. And so over the next 2 months, inflation, as measured by CPI, is going to be continuing to come down into the low threes, which ultimately is another sign for the bulls that yields probably have peaked, regardless of what the Fed's done. So I just think we're going to continue to have a small summer rally, because I don't think that the economic data is strong enough to push yields that much higher.
So, Joe, Bryn makes an interesting point, this idea that other sectors can lead. They did last year. Yeah, that's great when energy is crushing it and healthcare is crushing it. Mm-hmm. But what's crushing it now beyond tech? What looks like it wants to crush it beyond tech? You're closer to a potential recession now than you were a year ago. The alarm bells of that maybe aren't, flashing still, but maybe they will. Without, absent one of these other sectors starting to pick up, you need tech.
Well, first of all, Europe is in a statistical recession, 2 consecutive quarters of negative growth. China's declining. If you want to understand why energy is underperforming in a year in which OPEC is reducing supply, it's because Chinese economic growth and the reopening has been muted. So you're studying other sectors. You could look towards industrials and say year to date, yes, they're strong. I don't think that's going to be strong enough to maintain momentum in the market if technology falls to the side and industrials can't be expected to have the leadership. So I look overall, and back to Steve's point regarding price, I think what we're seeing is that momentum in this quarter is going to plateau. Momentum's going to plateau. I don't think it's going to peak, and I don't think that's going to change the narrative of 2023, because this isn't 2022. The fundamental catalyst in 2023 has been technology. And no, I don't expect other sectors, if technology plateaus, to step forward and do enough attribution to advance the S&P further. I don't think you want to get away from technology. I think the story of 2023 is it's the year of technology, not 2022 energy, materials, financials, and healthcare.
Is it still going to be the year for technology if interest rates remain elevated, Weiss?
Yes. And not all technology, because we've seen some still haven't performed. We see the semis, with the exception of an NVIDIA or something, have been left behind. But yes, because they don't need funding. So they've got fortress balance sheets. So it's Microsoft, it's Apple, it's even Amazon. They've already funded. So they don't have to come to the market.
But,
so
this idea of, and it's been dispelled in large degree. And if Mike Santoli is going to join us later for his midday word, where he made it clear he never liked the sort of direct link between higher interest rates and the demise of longer duration assets, right? They've proven that that tech can do well, obviously, when rates are still elevated. So maybe that's to your point as well.
Yeah, no, I agree with that, but I don't think it's as broad as maybe that statement is. It's companies that very clearly, can grow in any environment, or those that don't have to.
Well, maybe
Mark doesn't care, like Apple.
So you're saying maybe the ARC type names are the ones that are more susceptible to higher rates. The mega caps are not, for all of the reasons you listed at the very top of the show.
Right. If you're losing money, or if your sensitivity analysis as you go through your earnings model is dependent upon interest rates and borrowing costs, because it's not only the cost, it's not only your balance sheet, it's the borrowing cost for your day-to-day operations.
Longer duration, higher valuation.
Right.
That's the sort of connect. These massive valuations that a lot of these stocks were trading at, those are the ones that are super susceptible to higher interest rates.
Right.
And those are the ones, if you are longer duration. Something underneath the surface of Q2 that was very bullish was that you saw the secondary market return once again. Secondaries increased 60% from the first quarter. And guess what? Those companies that actually did a secondary offering, they're up 5% from where they did the offering. So I think as you move into the upcoming quarter and think about a lot of those long duration equities, boy, I think that's foolish management not to think about raising capital in this environment and doing a secondary. And then you say to yourself, okay, well, what's the response in that scenario? Do you see those stocks peak at that point? I would argue that I think you will. I think you watch the secondary market in the upcoming quarter as it relates to specifically the non-profitable long duration businesses.
Bryn said she still thinks we're primed for a summer rally of sorts. Do you, Weiss,
to me,
agree with that?
I hate to cop out, but it's data dependent.
Yeah.
I mean, it's very data dependent.
Well, she thinks the CPI is going to be very favorable.
And I think that's right. And I'm sort of making that bet, too, because I haven't hedged anything. I won't hedge anything going into the inflation number, because I do think you're starting to lap the most aggressive increases in inflation. So just sheer math says they should roll off. There'll be stubborn parts of it, but this is a glass half full market. So you parse everything. You'll say, okay, I understand rents may still be elevated, but look at used car prices.
Used cars rolling over. I mean, and they're a third of core.
Right.
As Tom Lee was pointing out today as well. Bryn, I mean, that's what you need to hang your hat on if you're bullish, right? The bullish scenario is continued good growth with continued moderating inflation.
It seems that earnings will be okay. I think what started to spook the market is that obviously just looking at the 2-year, you were just slowly creeping up to that 5% and then we're there. The 3-month is at 5.4. And so I think that's really what's put pressure on the market, is that you have, 4 handles.
ECB's Nagel says euro area inflation remains too high.
Clearly that's going to give competition in the short term to like large pensions, certain asset allocators. I was like, do I own equities or do I own bonds when I'm getting 5.4%? But I think that the data that comes out is going to continue to show us that GDP is slowing and that inflation is coming down. I think that's going to happen over the next few months. What happens in the back half of the year is another battle to fight. But right now, I just see the data getting weaker and weaker, which to me puts a lid on rates, therefore allows for the market to continue to rally.
So, Joe, like we say what the bull case is, right? Continued good growth. The economy continues to surprise. You got, the CPI confirming that inflation continues to moderate. The bear case is that you've got sort of lackluster growth. Inflation's really sticky, and that the market's already accounted for the bull case, right? The market's gone up a lot in the first half of the year.
Well, I think
which sounds like it's a more credible case to make.
Well, I
the
think,
bull or the bear case.
Okay, so let's be completely candid. I think where we are in the calendar is the most complicated and most difficult, trying to figure out the investment strategy over the next 90 days.
No, July's right. July's usually pretty good.
July, historically, for the NASDAQ is pretty good. But to Steve's point, okay, we've got CPI being reported. We've got an earnings season where is it going to be another 7% contraction for earnings, 3 consecutive quarters? On the other side of that, if guidance isn't good, the analyst expectations are you have a very sharp snapback in the following quarter, and you're out of this earnings recession. So if there's more of an earnings recession malaise, I think that correlates to an environment where stocks really struggle and move in a sideways to lower pattern over the next 90 days. I think the good thing is, I do think we've built in a buy the dip mentality for technology and mega caps.
We've also built in, Bryn, the idea of bringing down earnings expectations and then jumping over the low bar. That's sort of Goldman Sachs' view today. They expect companies to be able to meet the low bar set by consensus. And, you know, going into every earnings season over the last 3 or 4, it's like, oh, my God, earnings are going to be bad. They're going to start being really bad. And they really haven't been. Now, they may at some point, but they still haven't been. And maybe this time they won't be again.
Well, right. Well, we have a market of stocks, not just a stock market. So I think it's going to be dependent. But no, I think that obviously that makes sense. I think what will be interesting, though, is that I do think, especially like with the big cloud providers, I don't see they're spending all this new CapEx. They're going to just start really ramping that up with all of the uncertainties in the economy. I do feel that very confidently they are spending on AI. So to me, what will be interesting is within the big companies, are they spending less on the hardware, on the networks, which would hurt like an HPE or a Dell or those types of companies. So I think that's, to me, is going to be really interesting to start seeing where these companies are and are not spending within technology. And I do think there's going to start to be some winners and losers and some dispersion between the companies' spend on AI versus that CPU type of spend that they've had for all these years before.
Let me give you a couple of observations. First is that in this quarter, while earnings are forecast, top down, earnings forecast to be down 7%, it's below trend in terms of the revisions, lower revisions from the end of the second quarter to third quarter reporting. So it's below trend. So expectations are there that, to exactly what you're saying, that the bar has been set very low, and it's always exceeded. Always, no matter how bad.
But they've been so, as our buddy Josh Brown was putting on Thread today, they're too pessimistic.
Well, down 7% is pretty pessimistic after what you've seen last 2 quarters.
They're going to be too pessimistic again.
Right.
Is his point.
Well, they've got a freebie to do that because that's the thought process. The other side, going back to your other question, taking into account Bryn's comments, if you look at the private markets, very, very difficult for VCs to raise money. And you're not seeing a lot of new companies get funded, and you're seeing a lot of existing companies that are on the precipice of going belly up. And the reason being is that VCs are saving their money because they don't know where they're going to have to deploy capital in their current portfolio to prop up those companies because they can't raise external capital. So that's going to, so if we go take that and say, okay, what about public companies? To Bryn's point, I agree. You can see much more caution on CapEx, which is not good for the industrials that have also seen multiple expansion this year.
So, Joe, Mike Wilson on earnings suggests that, of Morgan Stanley, of course, that better than feared is likely no longer good enough. Do you agree with that?
No. No, I don't agree. Listen, a lot of what Mike has said over the last 6 months, I disagree with. I think
because he's been looking for an earnings apocalypse,
Mike
and a stock market to follow.
Right, and it hasn't happened, and the market has gotten away. I think, unfortunately, a lot of people who followed that narrative, not just specifically for Mike, but they turned towards cash yielding equivalents, and now they're in a very difficult place. How do they reinvest into the marketplace once again? So if, in fact, you can get the opportunity off of earnings where the market is going to pull back, that's why I think there's this very strong condition that's going to exist where there's going to be the buy the dip mentality. And to your point on capital availability and the cost of capital right now, it directs investors right back towards the mega cap. It directs the investor towards the $97 billion of free cash flow sitting on Apple's balance sheet, or the $60 billion at Microsoft, or the $57 billion at Alphabet.
Yeah.
Those companies.
ECB's Nagel says GDP may slow, but convinced the hard landing can be avoided.
And keep the overall trend.
You know, in fairness to Mike, we have gotten the earnings apocalypse, right?
Not really.
Come down about 20%. But we've not seen the stocks react to it, and it's been bifurcated between the
we've
haves
seen
and
earnings
have-nots.
come down, but it hasn't been to the degree that the bears have suggested it was going to get to.
Broadly, it's absolutely true. We've seen the vulnerability in energy, primarily, right? Leading materials as well, and financials to a certain extent. The rest, it hasn't been an apocalypse.
Well, that's what's upset the bearish case more than anything else.
This stream is sponsored by TickStrike. TickStrike allows you to actually hear order flow in futures, forex, and stock instruments. Get a free trial at tickstrike.com.
The rally that you've had. Now, tech is different than some of these other more cyclical and sensitive to the economy areas that we look at. He also suggests that the bull or bear earnings case is not going to be solidified, Bryn, from this earnings
Fed's
season.
Bostic says in many regards the US is still in a pandemic economy. A lot of strength is due to pandemic support.
Idea is just going to run out of gas. Do you buy that or not?
Well, I think that where the part of his piece was titled, "Do Earnings Matter?" And I think as investors, you have to remember, in the short term, it's about sentiment and positioning. And that's what you've had all year. You've had multiple expansion because of sentiment and positioning. Over the long term, all that matters is earnings. And so I think that's kind of where I agree with what Joe is saying, is that what he said earlier, that I think you're going to come back to tech. But I do think you have to understand, animal spirits are high. We got this multiple expansion because people think we have this new paradigm that the Fed has done. And to me, what would derail that later on this year is that either you have an event, which is typically what puts us in a recession, is this like unknown event, which we can't plan for that. Or if what we said earlier, inflation does get stickier, and then we have this, we're going to go a little bit incrementally higher, and then ultimately something breaks. But to me, that's a battle for another day. Right now, over the next few months, I don't see that people are going to become instantly pessimistic just because there's so much still excitement around what's happening in tech. And those animal spirits are really
Fed's
hard to
Bostic
push
says
down.
inflation is too high and not
So
sustainable.
before we take a break, I want to get to our chart of the day, which I've decided was going to be Meta, because it was, as a mega cap, up in a down NASDAQ tape, and up whereas it's other mega cap, well, now it's down, but it was up for most of the time until we came on. After its Threads, I mentioned Threads and this Josh Brown thing that he put on there, which I thought was interesting, reaches 100 million users in just a handful of days.
Fed's Bostic says the current inflation is not due to excessive risk-taking, but the pandemic response.
You know, a few bucks.
So we've been talking about this for the better part of the last week. There's optimism once again about utilizing a social media platform that can eliminate a lot of the negativity and just focus on quality content being delivered. And I think that's exactly what Threads right now is doing. It's re-energizing those that probably stepped away from the Twitter platform because of a lot of the negativity, the presence of bots, and the ability for one voice to have multiple identities. And there's this genuine optimism that Threads could be something different. Whether that's an unrealistic expectation, I think we'll find out over the course of time. But clearly right now, the engagement is far beyond, I think, what anyone expected.
Yeah, no, I'd agree with that. I mean, you have to link it to your Instagram account, so the anonymity sort of goes away, right? You just can't put, to your point, bots, and you can't have just the faceless haters out there, and that removes the cesspool of it. So
Fed's Bostic says the Fed is going to make sure it curbs inflation. The trajectory of inflation right now is in the right direction, and the Fed will ensure that continues.
Seen them leave Twitter, so now they can find a home. So I think it's very positive to renew some of the excitement about Meta. So why not? And Meta, by the way, is the cheapest of the mega caps. Almost by a wide margin, Alphabet accepted, and Alphabet's got some issues, of course.
You don't. You own it here? I
do
remember.
own it.
You do own it.
I do own it.
Would you add to it based on this sort of, I guess it's fair to say, new development?
Would I add to it?
Now they have to be able to, monetize this.
Yes.
in ways that Twitter, frankly, has not been able to do.
Well, it's both offensive and defensive. So it protects the Instagram franchise, not their, from more infringement by TikTok, right? TikTok's had some other issues. This is not new news. This news came out a couple of months ago. So I took the opportunity then, or a month or so ago, to increase my position. I'm not increasing with the market backdrop here with the binary event. If it got hit bad in terms of the inflation number coming out, a strong number, then I would.
I think they've done. I think they've done something that's far more important. They've restored the credibility in management once again. And that was really important. Yeah. They've moved away from talking about the metaverse. They focused on cost efficiency. They embraced the Brad Gerstner principles. And now, once again, you could believe in this management team that they're going to be focused in the near term on what the priority should be to grow the revenue and to protect the balance sheet. And I think threading is part of that, okay? The Threads platform is part of that story once again. And as long as we're not hearing about the metaverse, I think you've got to be
And think
happy.
of this timing of this, right? It came out, arguably, the company even said there'll be more updates. It's not exactly, and Joanna Stern is excellent, the Journal, not prime time, complete prime time ready. Sure. They took the opportunity to launch this when Musk came out and said, we're limiting the number of tweets, right, that you can look at. We're looking at the number of tweets that you can put out there. So they took Twitter at arguably its weakest moment, of which it's had many, many, many since he acquired it, and been right there. So management is very strategic.
All right. Let's go ahead and take first break. When we come back, more trouble in the Magic Kingdom. The latest headline on Disney that is pressuring shares yet again today. We break down the details. There's a stock down 0.75%. We'll get into it next.
Moody's says on the US jobs market, Moody's says the US jobs market is cooling, but not fast enough for a permanent Fed pause. So Moody's on the US job market says the job market growth is solid but overstated by rebuilding of the public sector payrolls, which lagged private sector in the past 2 years.
All right, welcome back. Disney shares, we just showed you under a little pressure today.
And Moody's says on the US jobs market, weakness is to remain concentrated in the interest rate sensitive goods sector before broadening to service sector activity.
Travel analysts and advisors say traffic to parks has slowed this summer. Line waiting time shows the Independence Day weekend was one of the slowest in nearly a decade. That recent price hikes and changes to park operations have soured some families on visiting. You, of course, owning Netflix, which you have reminded us on
Ted
numerous
Bostic says
occasions
recession
as
is not the
stocks
baseline
go
outlook.
like this.
Listen, and I'll continue to look. I had a conversation with Jenny and Jim last week about Disney, and I think each of them believe that the valuation for Netflix is extreme. My argument is, why not? There's an element of the cost of capital when measured by time. Why not in the near term, while you're waiting for the turnaround to Disney, give consideration to Netflix as a very compelling alternative? Why? Scott, it's a simpler story than what's going on.
And Moody's on the US jobs market says we expect the tech sector weakness to persist in 2023.
It's near the December low at $84. Bob Iger, he will figure it out. He's a legend. He's a Hall of Fame CEO. He'll figure it out. But it's a complicated story, okay? What is?
I got a comeback for you, but finish.
What is the jewel of Disney? ESPN. What do we hear about at ESPN? Significant reduction in headcount. We have challenges at the parks. When we think about content, who has restored the content back to the quality level that we knew it to be from years ago? Netflix, without question. The content as Disney is just not there. So I look at it from the aspect, I understand and I respect the viewpoint valuation-wise that Jimmy and Jenny have, but I look at it in the near term and I say, is there a fair alternative where I could keep my money in the interim? And to me, without question, from a momentum aspect, it's Netflix all day.
The only comeback that I can think of is, that's great. It's already in the stock.
Yep.
That's why Netflix is up 134% over a year and 50% year to date. The more compelling buy, if you're looking for value, why wouldn't it be Disney, given all of the hair on the stock and the story being known? I mean,
how about you're 100% correct? 100% correct. From a value perspective, looking longer term, looking through the lens that someone like Jimmy or Jenny would look at, without question, that's not the lens I'm looking at. I'm looking at the lens of my money in the interim, where it's going to be treated better. I think it's going to be treated better.
Ted Bostic says policy right now is clearly in restrictive territory. The Fed can be patient. Says the biggest risk is not moving inflation back to target. All Fed is in consensus on that view.
So while revenues will be fine, will be the same. You'll see their earnings be better than expected because of lack of content spending, because they spend so much on it. So their competition, Netflix is competition also. We've heard Jassy talk about Prime. So they're going to spend less money on content in Prime. Apple's never been a big spender on it, so it's not really a competitor. They have a low subscriber base, I think 20 million subscribers. So Netflix is really the only game in town. In terms of Disney, yes, there is a lot of hair on it, but what are the catalysts turn around? They talk about taking ESPN and making it all subscription. That's going to open, in my
Ted Bostic says the economy is starting to slow down, with job growth slowing down and inflation coming down, among other signs.
In these cases, you often hear.
Everyone, we're going to end the stream here. Thanks for watching today. Again, sorry I wasn't on the mic. We had some work being done at the house, so it would have just been quite loud in the background. Then he literally left about 3 minutes ago, because don't forget I'm in the UK, so it's 5:30 here. So, yeah, they've just left. But tomorrow, shouldn't be no one here, so we can be back to the live streaming. So we'll be doing that. Hope you enjoyed. Again, earnings seasons does start today. After hours, I think the only main one, or big name, is WD-40. But really coming into the end of the week is all the big names. You've got Delta. We have JP Morgan, Citibank. I mean, we have that's when all the big names are coming out. So end of the week's going to be the key thing. Again, Wednesday we have CPI. So tomorrow is going to be probably a bit more of a slower day. And then going into those last 3 days of the week, we should be moving quite a bit, and it should be exciting. So I hope you enjoyed the stream. If you did, why not drop a like and subscribe, and hope to see you next one.